If you earn £45,000 a year and cut your week from 5 days to 3, your salary falls by exactly £18,000. That number looks brutal on a payslip. But because of how the UK tax system is built in bands, your bank account will not feel anywhere near an £18,000 hole. You are probably sitting in what I call the pre-retirement corridor, somewhere between 55 and 65, tired of the Monday alarm but not ready to hand over your whole income. The fear is real. Drop to 3 days and you worry you will break your pension, fall short on your national insurance record, or end up living on beans on toast for the next decade. Here is the part almost nobody tells you. Most people assume a 40% cut in hours means a 40% cut in lifestyle. For a typical mid-career earner, the actual drop in spending power is often closer to 25 or 28%. Not nothing, but nowhere near the number that keeps people stuck in jobs they are ready to leave. That gap between 40% and 25% is often the exact difference between feeling trapped and feeling free to hand in your notice. I want to walk you through what I call the 3-day math. It is the calculation that protects your state pension record, keeps your workplace pension ticking along, and lets your private pot keep growing untouched for 4 more years while you work less. Before you hand in your notice or sign a new contract, we need to look at something I call the take-home illusion. It is the reason a 40% pay cut on paper almost never turns into a 40% pay cut in real life. Let us put real numbers against this. Someone earning £40,000 a year drops their hours and moves to £24,000, a straight 40% cut in salary. On paper, that looks catastrophic. In practice, their take-home pay falls from around £2,650 a month to about £1,950 a month. That is a drop of roughly 26%, not 40%. The gap exists because of how income tax actually works in this country. The first £12,570 you earn in a year is tax-free, frozen at that level for years now. When you were working 5 days, that tax-free slice covered a small fraction of your income. Once you drop to 3 days, the same £12,570 covers well over half of what you earn. You are, in effect, firing the taxman from your Fridays first, because the days you give up are the ones that were taxed the hardest. You are not giving up on your career by doing this. You are optimizing the ratio between the hours you spend and the tax you hand over, which is a very different thing from quitting. Here is the mini-math. On the full-time salary of £40,000, a large slice of that final £16,000 above the tax-free allowance gets eaten by income tax and national insurance together. On the part-time salary of £24,000, a much bigger share of every pound earned stays in your pocket, because the tax-free allowance now covers more of the total. Think about what that monthly gap actually buys. A drop of £700 a month is roughly the size of an energy bill and a council tax payment combined for a lot of households. That is the scale of what is really at stake here, not some abstract percentage on a spreadsheet. The trap almost everyone falls into is assuming gross pay equals net reality. It rarely does, and the gap tends to work in your favor once you go part-time. If you are trying to work out this kind of math for your own situation, without handing more of it to HMRC than you need to, that is exactly the sort of thing this channel focuses on for people in their late 50s and 60s. Consider staying subscribed if this is useful. But there is a cost here that will never show up on your payslip, and it is the first question you need to put to your HR department before you sign anything. Before you touch your hours, there is one question that matters more than almost anything else in this whole decision. Does your employer pension match continue on reduced hours, and on what basis is it calculated? Some schemes match a percentage of your actual salary, so if your pay falls, the match falls with it. Others use a fixed contribution that barely moves. You need to know which one you have, in writing, before you commit. If your match is based on actual salary and you drop to 3 days, that free money from your employer falls by roughly 40% too. Losing something like £2,000 a year in employer contributions compounded over 5 years, works out to somewhere around £10,000 of missing growth by the time you actually retire. That is not a rounding error. That is the difference between one extra winter of comfortable heating bills and one without. There is also a question of how this change is made on paper. Is this a permanent variation to your contract, or a flexible working request that can technically be reviewed or reversed later? The wording matters more than most people realize, because it affects how your employer treats you if things change again. Here is the part people miss completely. Redundancy pay and death in service benefits are almost always calculated on your current salary at the time, not on the salary you earned across your 20-year career. If you drop to 3 days and then face redundancy 6 months later, your payout is worked out on the 3-day wage, not the one that reflects everything you built up before it. Your employer match might shrink when you cut your hours, but there is one contribution that usually stays fully intact even on 3 days a week, and it is the one that protects the most important number in your entire retirement plan. Here is a fear I hear constantly. If I work part-time, I will not get a full year toward my state pension. It sounds logical. It is also wrong for almost everyone reading this. For the current tax year, you only need to earn above what is called the lower earnings limit to bank a full qualifying year. That threshold sits at £129 a week, or £6,708 across the year. Since the new state pension reforms landed back in 2016, the whole system has revolved around building up 35 qualifying years, not around how many days a week you physically show up. Even on a modest part-time wage of £15,000 a year, you are comfortably clear of that threshold. That means someone working 3 days a week is banking a full year toward a state pension currently worth £241.30 a week, while only working around 60% of the hours a full-time job would demand. You are not trading away your pension record to work less. You are getting the same qualifying year for a fraction of the hours. Picture what that £241.30 a week actually represents once you reach state pension age. It is not pocket money. For a lot of people, it becomes the floor their whole retirement budget sits on, the amount that arrives whether markets are up or down that month. A lot of the anxiety around dropping to 3 days comes from mixing up two completely different systems, the state pension and your workplace pension. Cutting your hours barely touches the first one at all, provided your part-time wage clears that fairly low threshold. So the trade here is simple to state plainly. You protect that weekly floor completely, while buying back something close to 100 days of your own life every single year you work 3 days instead of 5. There is a second threshold that catches people out, and it has nothing to do with your state pension. It is called the earnings trigger for automatic enrolment, and it sits at £10,000 a year. Drop your part-time pay below that figure, and your employer is no longer legally required to auto-enroll you into a workplace pension at all. Most people reading this will not go anywhere near that low, but contributions themselves are only calculated on a specific band of earnings, currently running between £6,240 and £50,270 a year. So if you earn £12,000 on your 3-day week, your employer is not putting money in on the whole £12,000. They are only contributing on the £5,760 that sits above the lower end of that band. I have spoken to people who took what felt like a fun, low-pressure part-time role paying £9,500 a year, thinking of it as a soft landing into retirement. What they did not realize is that £9,500 sits just under the £10,000 trigger, which meant they had quietly opted themselves out of a 3% employer contribution they had relied on for years without ever making an active decision to give it up. A few £100 a year in salary either side of that £10,000 line can be the whole difference between an employer topping up your pension and an employer paying you nothing extra at all. That is the danger zone worth knowing about before you agree to any specific hours or pay. But it is not the biggest risk in this whole plan. The biggest danger is not what you earn on your 3 days. It is what you decide to withdraw from your pension while you are still working the other 2. Picture this situation. You have dropped to 3 days. Somehow you are still short by roughly £500 a month, so you decide to take a small taxable withdrawal from your SIP each month just to bridge that gap. It feels harmless. It is not. The moment you take a single pound of taxable income out of a defined contribution pension, you trigger something called the Money Purchase Annual Allowance, usually shortened to the MPAA. Once triggered, your annual pension contribution limit does not stay at £60,000. It drops instantly to just £10,000 a year for the rest of your working life. This is what people underestimate the most. It is a one-way door. You cannot trigger it and then untrigger it later. If you get a pay rise in a few years, or want to put a big bonus or an inheritance into your pension to catch up, you are stuck with that £10,000 ceiling permanently, no matter how much room you had before. There is a safer bridge that avoids all of this. Taking only the tax-free cash element of your pension, usually the 25% lump sum under what is called UFPLS, does not trigger the MPAA at all. Pairing that with withdrawals from an ISA covers most short-term income gaps without touching your annual allowance. This year matters too, because it is the last full year the whole £20,000 ISA allowance can go into a cash ISA before that limit falls to £12,000 for anyone under 65 from April 2027. I used to think of a pension as just one pot, all treated the same way by the tax rules. It took seeing this trap catch someone I knew to understand that the line between tax-free cash and taxable income is not a technicality. It is the difference between keeping your full £60,000 allowance and losing 5/6 of it overnight. Avoid this one trap, and the whole 3-day math starts to look less like a compromise and more like one of the smartest moves available to you in your 50s or 60s. Let us run 2 paths side by side, using round numbers to keep this simple. Path A retires completely at 60, with a pension pot of £400,000, and starts drawing 4% a year straight away, around £16,000 annually. Path B keeps working 3 days a week until 64, holding the exact same £400,000 pot, but leaves it alone completely while their salary covers day-to-day life. At an average real return of 5%, that untouched £400,000 grows to somewhere around £486,000 over those 4 years without a single extra pound added by hand. That growth comes purely from compounding, from the pot being left to do its job instead of being drawn down for income. Nobody added a single extra pound of savings. The only difference is that the money was never asked to pay a single bill during those 4 years. Working 3 days is not only about earning a wage during those years. It also acts as a buffer for your pension pot, letting it keep compounding through what are often its most powerful growth years, simply because nobody needs to touch it yet. Put another way, that difference of roughly £86,000 is the sort of gap that could cover years of mortgage payments or fund the kind of gentle income top-up that turns a tight retirement into a comfortable one. Here is where the real difference shows up. Imagine a market downturn lands at age 61. Path A, fully retired and drawing income, is forced to sell units at a loss just to cover the month's bills, locking in that loss permanently. Path B, still working 3 days, simply lives on their salary, leaves the pot exactly where it is, and waits for markets to recover before ever touching it. There is one final part of this whole plan that no spreadsheet, however detailed, will ever capture properly. There is a mental trap that catches even people who have done all the maths correctly. We tend to picture retirement like a cliff edge, full income one day, nothing the next. Anything in between can feel like it does not count, like it is not a real decision. If part of you feels a little guilty for wanting to work less, or a little embarrassed that you are not doing the full 5 days like you always did, that reaction is completely normal. It does not mean you are being lazy. It means you were raised to measure worth by hours worked, and that habit takes time to loosen. Nobody handed you a rule book that said 40 hours a week is the only version of a normal life. It helps to think of a 3-day week less as giving up and more as a rehearsal for what comes next. You get something close to 80% of the lifestyle and freedom of full retirement while carrying almost none of the financial stress of walking away completely. Picture a Tuesday morning where everyone else is rushing into back-to-back calls, and you are heading to the garden center instead with a coffee in hand. That small, ordinary moment is where what I would call the health dividend actually shows up, not in a spreadsheet, but in how your week feels. You are not retiring early. You are working in a way your body and your bank balance can both sustain for longer. So before you make any final decision, run through this properly. Check your actual net pay, because it almost always lands better than the headline percentage suggests. Confirm exactly what happens to your employer pension match in writing. Stay well clear of the MPAA trap by keeping any withdrawals to tax-free cash and ISA money only. And then let the rest of your pot sit and grow while you work fewer days than before. For a lot of people in their late 50s and 60s, dropping to 3 days a week is not really a compromise at all. It might be the single most sensible financial and psychological move available to you right now. If you want the fuller detail on how the 2027 ISA changes I mentioned earlier will affect your own savings, make sure you are subscribed so you do not miss that one. Stay calm, plan ahead,